welcome to the March episode of Fintech Firebrand. I'm Virginie O'Shea, founder of Firebrand Research, and I'm here to chat to you about all this month's very fast-moving Fintech and finreg news. Now, I have to start the episode really with talking about what's been going on in the banking sector in both the US and in Europe. We've had quite a few events over the last couple of weeks, beginning with the troubles that happened within Silicon Valley Bank and also Signature Bank. We saw a bailout by the FDIC in the US to try and support SVB in particular. We saw the buyout of SVB UK over here for £1 by HSBC. So that was obviously a token gesture, but certainly something that we haven't seen in a very, very long time, and not something we've seen of this scale, to be fair. So certainly there's a lot going on. In Europe, more widely, we've also seen the woes at Credit Suisse over the last week, and with regards to their funding, where they've been lent money by the Swiss National Bank potentially, and obviously the central banks across the globe are keeping a close eye on potential contagion effects of what's going on out there. Now, obviously, it's a very serious matter. Has meant the loss of numerous jobs by different bank employees over there. Also, the fintech sector has been negatively impacted. SVB had a lot of fintech clients. They also struggled to get their money. Venture capital firms also. So certainly there's been a lot of industry debate about whether a bailout was the right action to take. There has been some pushback within the regulatory sector, and a lot of discussion is coming, I expect. Likewise with what's going on with Credit Suisse. Also, though, they can't be compared to each other. Obviously, SVB is a very different type of bank to Credit Suisse. Credit Suisse had a far more diversified portfolio, and obviously is a much larger bank in terms of global scale. So, and reach across all of the different geographic regions in which it operates. So certainly we have to keep a close eye going forward on what happens next. No doubt this will not be a good thing for the markets, given we're in a recession already globally. So hopefully things will even out. As we all know, the banking sector relies on trust, and bank runs of that scale are very unusual. Certainly the smaller bank sector in the US has been suffering in terms of stock prices over the last week or so as well. So keeping a close eye on all of these things, and certainly this will be something I imagine I will be talking about for the next few months, if not longer. Now, on the finreg front, there's always lots of activity going on within the SEC. As you know, every month I come up with something else to talk about from the SEC perspective. We've had, equity market structure changes of a huge magnitude, US Treasury market structure changes in terms of clearing as well, ongoing toing and froing on crypto assets and looking at cryptocurrencies in particular, although we've not had too much progress in terms of regulatory developments on that over recent weeks. But I must admit, the biggest topic this month, and similar to what's been happening in the UK and Europe as well, with regards to the Digital Operational Resilience Act, or DORA, the Explorer as I call it. The US, the SEC proposed 3 separate updates and new rules around the topic of cybersecurity and operational resilience. Now, one is the update to Reg SCI, which came into force quite a few years ago. I think it was 2014, if I'm not mistaken. And that regulation in particular focuses largely on market structure, providers out there like exchanges and trading venues, and data providers as well. The focus of that regulation has been on making these firms much more resilient from a cybersecurity perspective, but the updates are much wider in scale. They expand Reg SCI to a broader range of institutions, and they also impose a lot more requirements, much more prescriptive than the original regulation. So those proposals are up for public comment. At the same time, they also proposed updates to Reg SP, another one that is quite similar in tone to GDPR and with little hints of DORA in it as well, that focuses on disclosure of data breaches. Looking at different types of financial institution and making sure that the institutions in question, if they suffer a data breach, they let their clients know about that data breach. And they also report it to the regulator. The regulatory reporting and investigation also would seek for them, those financial institutions, to introduce more governance around data protection, data security, and data usage, hence the sort of GDPR reference that I made there. Now, the last regulation in question from the SEC, I mean, they had a lot of debate about this over the last couple of weeks, so I've been listening in, was a far more overreaching regulation. Now, there's quite a lot of debate amongst the commissioners about whether this is the right approach to cybersecurity, but it's an entirely new regime for cybersecurity that would cover most financial institutions out there, trying to encourage them to report to the regulator about their cybersecurity market practices, their data security market practices on an annual basis, and holding them to account for those practices. So obviously investigations would be made if those different plans and different systems in place were found by the SEC to be insufficient. So certainly a very big piece of work, and similar, as I say, in tone to what DORA is proposing in the EU. And now DORA is wending its way through the process at the moment of being implemented. We're getting the regulatory technical standards, and we're sort of working on a lot of the very operational aspects of DORA. So it's interesting to see that the SEC has been paying a very close attention to what the EU is doing. Likewise, the CFTC, the new Technology Advisory Committee, was set up this month. New chairs announced, and both of them, surprise, surprise, have cybersecurity backgrounds. So it will be interesting to see how the CFTC tackles what the SEC has been doing as well, whether they go the same route, whether they are as prescriptive, whether there's coordination. That's always a good question. So keep your eyes peeled for those coming out. Now, every month, I also give you an update on ESG, and this month is no exception. At the EU regulator level, so across all of the different bodies like ESMA, EIOPA, in the insurance side and the pensions side, all of the EU level regulatory bodies are now going to conduct a large potentially multi-year stress test for climate risk impact on the markets. And they've announced this. They said that this is going to happen before, looking at the period before 2030 in terms of the time of assessment, not when the results are being posted, but they're aiming for an end of 2024 delivery on that stress test. And those results could feed into any kind of subsequent supervisory programs that the regulator is working on. And obviously all of those regulators at the EU level are actively working on sustainability topics. At the ESMA level, we've seen obviously SFDR, the Sustainable Finance focused regulation that we've got there around the disclosure regime. We've got the CSRD as well. There are multiple moving parts to this. We've got the new green plan as well at the EU level. So certainly a lot of moving parts, but it'll be interesting to see the results of this stress test and what kind of impacts they have on the future direction of regulation too. And that will keep everybody very busy, no doubt, over the next couple of years. And for my final thoughts for the month, it was International Women's Day this month, and every year we have the same discussions, it feels like, about diversity on the gender spectrum and how little progress has been made, truly, at the global level and in individual country level and individual institutional level sometimes, with regards to targets that have been set around diversity and having more women on boards. Now, we've seen lots of very depressing statistics over recent weeks, and I was somewhat disheartened to see them. The EBA put out some gender diversity statistics in the European banking sector, and it feels like we are in sort of treading water rather than making progress in terms of getting more females on the boards of various European banks. We have, at the moment, looking at the statistics in front of me, 78 female CEOs versus 611 men with regards to European banks. So their EBA report is worth looking at. there are far more statistics than that are equally depressing. So I would like to say, rather than looking at things like embracing equity, I know that was the theme from some corners for this International Women's Day. Instead of looking at that, we should really think about challenging the equity statistics that we're seeing and asking why on earth progress is not being made, what more the industry can do. And this is not on just women, this should equally be on the men out there. Hugging yourself, as was shown in all of these photos that people were posting, isn't really enough. Embracing a sort of very token gesture, it's not nearly enough if we're going to change and manage to reach the targets that the institutions and the industry has set for reaching gender parity. And I haven't even touched on the lack of equality of pay. So obviously we haven't got people on boards. We equally do not get paid the same amounts by a long shot. And apparently progress is not going to happen sufficiently for us to reach equal pay in the next, I think it was 100 and something years. So that is not good enough. So my final thoughts for you this month is think about what your institutions can do, how you can help. If you're a man, woman, whoever out there, to try and raise the voice of equally, diversity in a broader context as well. And that's certainly something that I think we can all commit to over the next 12 months.